So the economic war is getting stranger and a big industry in Europe is under threat. We had the EU accusing China of overcapacity revolving around subsidies. And it's really weird when you realize that Europe themselves are throwing massive subsidies of their own. Von der Leyen herself approved 5 billion euros of subsidies for Germany. They are desperate for industries to return, so she just greenlit the plan. Throw a bunch of money to lure in the chip making giant TSMC. This is bizarre because it doesn't even solve the core problem. The cost of production is simply too high. Subsidies in this case just is a band-aid masking the bigger crisis. But we need to remind everyone of a big double standard here. Europe is doing the exact same thing they are accusing China of.
Global markets are now flooded with cheaper Chinese electric cars. And their price is kept artificially low by huge state subsidies. This is distorting our market. And as we do not accept this distortion from the inside in our market, we do not accept this from the outside. So I can announce today that the Commission is launching an anti-subsidy investigation into electric vehicles coming from China.
And now Beijing has retaliated. First was the probe into brandy and pork exports, which is a multi-billion dollar industry. Now the hammer is going to fall on agriculture once again. China is going after Europe's milk money. Beijing is investigating Europe's own subsidies for their dairy production. Almost $2 billion are now targeted, and this trade war is about to clobber farmers in Europe. Now, we are talking about milk, processed cheese, and cream at risk. And if this goes through, China's going to slap higher tariffs on these imports. It's really easy to think that this is inconsequential, and it kind of sounds funny on the surface, right? Targeting milk and cheese. But one has to look at the state of Europe today and the deep divisions across the EU. Hungary isn't on board with the EU agenda, and Italy is desperately trying to repair relations with China. This probably isn't a move to try to collapse Europe. It's more of a reminder of how unilateral decisions at the top can hurt individual EU economies. Some countries will get hit worse than others. Now, this looks like a trend, but once again, Germany stands to lose the most. They exported over 300,000 tons of dairy goods to China ahead of France and the Netherlands. China isn't that dependent on imports anymore. Their own domestic production has increased, so they have many cards to play across the entire supply chain. If we recall the farmers' protests earlier this year, it was a complete disaster. It erupted across Europe, France, Germany, Belgium, Poland, and more, and that was due to poor EU policies and rising inflation. Now, add on China's retaliation to the mix, the trade war is only going to hammer EU farmers even more. Cutting away a huge source of demand isn't a good idea now. You have a population of over 1.4 billion people, a big portion is going to move into the middle class, so the consumption of food is definitely 100% going to increase. China is part of the BRICS and they are trading partners with the entire world, so Europe isn't the only outlet for food imports. As Europe stands to lose, other parts of the world stands to win. In the first 2 months of 2024, China's trade with Central Asia is up by 13%. Latin America is up by 11%, and Africa grew by almost 8% as well. Each of these regions they export food to China, especially countries like Argentina and Brazil. Latin America is becoming the growing breadbasket for Beijing. The EU at this point really doesn't matter. China could effectively hit EU farmers with a ton of tariffs. Cheese, milk, brandy, all these are fair game now. We just need to look at the incredible wall of taxes Chinese EVs are facing, and you can kind of understand the need to retaliate. Three of the biggest EV brands in China, they are facing big punitive tariffs. SAIC got absolutely hammered at 36%, and this is on top of the existing 10% duties. So in total, EVs from this company are facing a nearly 50% price increase when the cars hit the showrooms in Europe. So things have devolved into a tit-for-tat trade war. You whack my manufacturing industry, I'll just clobber your farming industry. Dairy accounts for around 14% of total agricultural production in the EU. This is a very important sector in the food industry. The big question is if this is being held up by big government subsidies, does China really have a case here? Well, firstly, Europe has something called the Common Agricultural Policy or CAP, and the spending is absolutely crazy here. Just look at the numbers. From 2021 to 2027, the total spending was over 386 billion euros, and that is 31% of the entire EU budget, almost a third. If we break things down even further, it gets even crazier. Of that amount, 290 billion goes into direct payments and agricultural market measures. Basically, those are subsidies and payments to farmers to help bring down the cost of production. This helps to make EU exports more competitive versus poorer countries around the world. When we dig into the numbers, things get much clearer now. Europe itself loves all these subsidies. The EU isn't organically a low cost producer of food. Their prices are kept artificially low, artificially competitive because of all these huge government payouts. Why do you think China is aiming at this? Because the EU has an overcapacity of subsidies in agriculture. So the economic war will get worse. EU trade with China will only continue to decouple more and more. But let's go to our next story because this is truly wow. Argentina's gold has now arrived in London. The UK received a gold shipment of $150 million from Argentina, and the physical gold is used as collateral in the London bullion market. Argentina sending their gold to London is really a sign of desperation. They are broke, they need money, and they are pledging their gold for the funds, and that's the most likely scenario. The justification, however, is really bizarre. It seems Argentina has forgotten about the true purpose of gold. It is a store of value that's free from counterparty risk. If you store it in another country, what's the point of that? According to Luis Caputo, the economy minister, it's all about earning some returns. If you have gold in a central bank, it's as if you have assets that can't be used for anything. If you have it outside the country, you can get returns. It's much better to have it guarded outside where they pay you something. Now, I've no idea how much the returns he is talking about, but it's probably not worth it. You shouldn't be treating gold like a stock or treasury bond. Even if the lease rate on the gold is 3 to 5 or even 10%, it's not worth it. And a big shout out to our sponsor today, Indigo Precious Metals. When it comes to buying gold and silver, I trust Indigo Precious Metals in Singapore. They have made investing in precious metals safe, fast, easy, and simple for both small and large scale buying. I've been stacking gold for over a decade now, and I've learned two things when buying. You want to buy authentic gold bullion, and you want to buy it at the lowest premium possible to stretch your dollars even further. And I'm glad to say I found both of this at Indigo Precious Metals. There's a lot of uncertainty in the world today. We have geopolitical chaos and the values of fiat currencies getting debased. Inflation is not gonna end, and that's why I consistently buy gold to preserve my wealth. Indigo Precious Metals is a leading retailer in Singapore. They specialize in physical gold, silver, and platinum. They are my one-stop shop when it comes to buying bullion. Their prices are sharp, and they have the best brands on sale, and I can test the gold on the spot. So if you're looking to make your first gold purchase, Indigo Precious Metals is the best place to start. Whether it's 1 ounce or 1 kilo, this is the reputable dealer you are looking for. So take action today. Click on the link below and enjoy a discount on your first purchase with the code SeanFu. Start your gold stacking journey today. Gold is an asset that should be kept on hand in case of a national emergency. If you need to sell your reserves to raise cash, you need a gold bullion where in your national vault. The Buenos Aires Times has a very interesting article that highlights this enormous risk. Could Argentina's gold reserves be seized due to the YPF debt? YPF in this case is the Argentine National Oil Company, and because of a previous attempt to nationalize the company, Argentina itself faces a penalty of $16 billion they are on the hook to pay this up. And this opens up a whole can of worms. Can their gold stored overseas be seized? This might be an order from a US court, but can they order London to liquidate the gold to pay off creditors? And all this is rather hazy and might not happen. But the whole point of gold reserves is to have it in your national vault. And that's why India and even Poland brought home their gold from the Bank of England. Inflation is still a problem in Argentina and they are still facing a recession. So there's always a chance they might need to liquidate the gold for dollars. Storing it in London isn't the smartest idea by far. But let's pivot to the US dollar because the strong dollar, as we know, might be bound for a crash. This time we are talking about the relative strength of the dollar versus other currencies. And this is important because if the dollar falls hard enough, we could see money leave US assets and enter other places like the emerging markets. Citibank is telling us big hedge funds are using US dollars for a new type of carry trade. And this is very different from the yen carry trade that blew up global markets earlier this month. And here's the key difference, and it's very important we understand the big distinction here. Investors, they are borrowing in US dollars rather than yen for their wages, their bets on emerging markets. For example, they are borrowing a million US dollars to buy emerging market bonds from countries like Brazil, for example, or they are borrowing dollars to convert to RMB to buy Chinese stocks. The big money, they believe the relative value of the dollar versus other currencies will collapse. So when it comes time to pay back the dollars they borrowed, it becomes cheaper. Now, the implications are very big, it is huge. This means emerging markets could actually outperform the S&P in the months and the years ahead. If the dollar is going to fall in strength, it's time to short it and go long something else. For over 2 years, the Fed has been hiking rates, and they made the dollar stronger and stronger versus other currencies. But Powell has confirmed a new rate cutting cycle. So the global currency crisis is going to reverse on the US. And this chart of the yen bets shows us something really interesting. Since 2021, people have been betting against the yen. It was a no-brainer trade. They were betting on the yen to fall because the dollar was strengthening. But now, we have gone from minus 100,000 contracts of negative bets to positive territory. This means people are betting that the yen gains value while the USD loses value. So, what does this mean for you and me? If this momentum continues and money piles into this dollar carry trade, we could see other stock markets outperform the US. Gold is also going to get a nice headwind. Remember, gold is priced in US dollars. So if investors they start borrowing and selling dollars, this will drive its value down and make gold more expensive to own. And how likely is this going to happen? Well, let's look at expectations for the Fed rate cuts. What the market is actually telling us. These are the expectations for US interest rates by the end of the year. If we look at the majority, it looks like we are in store for quite a few cuts. 70% of people believe we are getting 4 to 5 cuts. In other words, interest rates will be moving from 5.5% down to around 4.25%. So dollar strength could indeed continue to fall. And if more cuts come into the picture, the currency strength will just plummet. Now, this isn't written in stone. There's still a very big wild card that could derail this and send the dollar even higher. And that is an oil crisis, and we are on the brink of one yet again. Israel and Hezbollah just traded missile attacks. Lebanon and Israel, they have been hit. The US is also sending more naval forces to the region. The second US aircraft carrier has arrived, and it looks like everyone is just prepared for all-out war. So if we get that, then all hell breaks loose. Oil will spike back to 100, inflation will rebound, and rate cuts will have to stop or slow down, and that will explode the dollar higher, which is a tail risk. And to be honest, it looks increasingly more likely. Remember that Blinken was in the Middle East for ceasefire, and the talks totally collapsed. There's still no truce today. Blinken couldn't seal the deal. So we are one breath away from another geopolitical disaster. Peace is still an illusion, and we better prepare for more chaos ahead. But let me know what you think. Will China punish EU milk and cheese? And did Argentina take a very big risk putting their gold in London? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.